Hello everyone, we are going to present for our FIN 3044 Finance Analytics assignment. Our topic will be the oil and exchange rate market performance.
Hi, my name is T. Kaijin, and I will be presenting my part on introduction. Let me begin with the exchange rate market. The foreign exchange rate market, or Forex market, is a global decentralized market where currencies are traded and exchange rates are determined. An exchange rate is simply the price of one currency in terms of another, set by supply and demand. This market is enormous, with approximately $5.3 trillion traded daily. Its key functions include enabling international trade, facilitating foreign direct investment, and portfolio investment, and acting as an economic shock absorber for countries using flexible exchange rate systems. Now, looking at our three focus countries, each adopts a different approach. Malaysia uses a managed float regime, where the ringgit floats but the central bank intervenes heavily, especially since the 1997 Asian financial crisis. Singapore has a unique approach, using the exchange rate as its main monetary policy instrument rather than interest rates, given its extremely open economy with a trade to GDP ratio of about 280%. Thailand falls somewhere in the middle with a managed float system, allowing the currency to float freely but intervening occasionally to prevent excessive volatility. Next, let's discuss the oil price benchmark used in this study, the West Texas Intermediate or WTI crude oil. WTI is a premium grade of crude oil produced in the United States, specifically from the Permian Basin in Texas. It is considered light and sweet, meaning it has low density and low sulfur content. WTI serves as the primary oil price benchmark for North America and is the basis for futures contracts based traded on the New York Mercantile Exchange. It is priced at the Cushing, Oklahoma trading hub. For Malaysia, being a net oil exporter, high oil prices positively affect the economy through improved trade balance, increased fiscal revenue, and higher GDP growth. However, for Singapore and Thailand, which are net oil importers, high oil prices lead to higher import costs and inflationary pressure. This sets up a natural contrast between the three countries that we will examine. Now, how do oil prices and exchange rates relate to each other? There are three main transmission channels. First, the terms of trade channel. When oil prices rise, oil exporting countries earn more revenue from exports, increasing demand for their currency and causing appreciation. Second, the fiscal channel. Higher oil revenue improves government budgets and investor confidence, attracting foreign investment and strengthening the currency. Third, the volatility channel. Oil price uncertainty can cause capital to flee from emerging markets to safe haven currencies. The key contrast is clear. Malaysia, as a net exporter, tends to benefit from rising oil prices with currency appreciation, while Singapore and Thailand, as net importers, face depreciation pressures and inflation risks when oil prices increase. First, studies have found asymmetric effects. Hussaini and Lin in 2021 showed that oil price increases affect producer prices more than customer prices across Malaysia, Indonesia, and Thailand. They also found that currency depreciation raises both CPI and PPI, but appreciation does not lower prices. Second, crises amplify the oil FX correlation. Multiple studies found that during COVID-19, volatility spillovers between oil and foreign exchange markets intensified significantly. The pandemic structurally altered market interrelationships. Third, the relationship is not linear. Researchers have identified what they call dark causality, hidden causal interactions that conventional methods miss. The oil FX relationship changes depending on the market conditions, exchange rate movements, and whether a country is an exporter or importer. Recent 2024 studies on Asian market also show that exchange rate act react differently across countries, with countries like Chinese yuan and Japanese yen exhibiting safe haven characteristics during stress periods. Looking at market context from 2020 to 2026, we have witnessed significant volatility. WTI prices crashed to about $30 during COVID, surged to $120, settled around $70 to $90, then rose drastically in 2026 due to US-Iran tensions. Forex markets were equally volatile. Despite extensive research, existing findings are conflicting and inconclusive. The relationship is nonlinear, time varying, and depends on market conditions. Studies have found dark causality and three-phase dynamics, but there is limited comparative research specifically on ASEAN countries. Additionally, few studies cover the recent 2024 to 2026 period, incorporating both post-pandemic recovery and new geopolitical tensions. Our study addresses these gaps by using wavelet correlation and coherence analysis, which allows us to examine relationships simultaneously across different time horizons: short run, medium run, long run, and very long run. This overcomes limitations of traditional methods like VAR or ARDL. To conclude, this research has three main objectives. First, to evaluate the existence of any long-run equilibrium relationship between WTI oil prices and the exchange rates of USD to MYR, USD to SGD, and USD to THB. Second, to study the effects of volatility spillovers from oil prices to these currency pairs. Third, to analyze the differences between Malaysia as a net oil exporter compared to Singapore and Thailand as net importers. Our study uses weekly data from 2020 to 2026, covering three distinct crisis periods: the COVID-19 pandemic, the post-epidemic recovery, and the recent geopolitical crisis involving US-Iran tensions. This research contributes by providing contemporary evidence on oil FX dynamics in the ASEAN region during a period of significant global uncertainty. Thank you for your attention.
Hi lecturer and my friends, I'm Leader. So this slide summarizes the methodology used in our study. First, under the data design, we use weekly closing price data from investing.com. West Texas Intermediate or WTI crude oil was used as the market proxy and was measured in US dollars per barrel. Our sample covered 10 currency markets: Malaysia, Singapore, Thailand, Saudi Arabia, Japan, the Eurozone, United Kingdom, Canada, Australia, and India. The sample period was from 5 January 2020 to 31 May 2026. We initially collected 335 weekly observations for each variable. Second, for return preparation, the low price was converted into simple weekly percentage return using the formula shown on the slide. The current values minus the previous value was divided by the previous value and multiplied by 100. Because the first observation had no earlier value, we removed it. This left 334 weekly return for each series. For the exchange rate, a positive return means the domestic currency weakened against the US dollar. Before the analysis, we checked the data for missing value, duplicated debt, and non-numeric entries. We used eViews for the conventional analysis and RStudio for the wavelet analysis. Next, we applied the 5 empirical methods. The first one, line graph was used to show price and return trends, volatility, and period of market stress. Second, descriptive statistics summarize the average return, range, volatility, and normality of each series. Third, Pearson correlation measure the direction and strength of the relationship between the WTI return and each exchange rate return. Then, we ran a separate OLS regression for each of the 10 exchange rates to test whether WTI returns had a significant relationship with exchange rate movement. Finally, wavelet correlation and wavelet coherence were used to examine how the relationship changed across the different time period and investment horizon. Overall, this method allows us to study both the average relationship over the full sample and temporary relationship during the specific market condition. Thank you.
Thank you, leader, for the presentation. So after we have been obtaining and concluding the raw series data, basically we have came out with a line graph interpretation for easier understandings. So let us walk through on the line graphs here. So starting with the WTI crude oil price, the top pattern that jumps out massively was in the incident where the price of the WTI jumps to $120 per barrel in just 2 months, which is happened in the late 2021 to the earlier 2022. That wasn't randomly happen. It was mainly due to the COVID-19 era supply chain bottlenecks, where uh, the market has been tightened due to the global lockdown. So when the demand rebounded due to the openings from the lockdown, the supply couldn't keep up with the demand. So basically, is the supply more than the demand more than the supply lah. So after that, the price of WTI actually settled back to the normal range within $70 to $19 per barrel until the earlier 2026, which was recently happened due to the US Iran conflict, which disrupted the shipping through the Strait of Hormuz, where is a dilemma between the supplies and demands, where the supplies would like to constantly supply, but due to the disruptions of the straits, the demand couldn't be receiving their demand lah. So after that, let's look about the forex charts. As mentioned in the slides above, we have 10 different currencies from the 10 different countries. So basically, they share the same patterns lah, the spikes and the downs. So the first cluster, as we can see, is was happened in the early 2020, which was happened in the COVID-19 era, where the global lockdowns triggered a rush out of the risky assets. So the investors might be freaked out with their investments because it comes with the COVID-19 compensates us a very high uncertainty. So citizens and also the investors uh, quickly withdraw their money from the investors and in their investments and their currency investments. That's why it makes a huge spikes lah. Then the second clusters was happened in the year of 2022. So basically, it was incident where have a clearer driver, which is the incident of the U.S. Federal Reserve, which we call it a Fed, has aggressively raised their interest rate about 11 times within just 17 months. So that has pushed the US dollar to a very high demand, and that's why it makes the massive spikes in most of the graph here, as we can see from the slides lah. So overall, the both oil and the currency markets shows the same story. It was deter and interfere due to the global shocks, whether it's a COVID-19 demand or like a geopolitical conflict such as the US Iran. So as for the return series interpretation, basically is about the same as the raw series data. They actually share the same patterns in the line graph. Is mainly due to that the return series is actually just to convert the raw series data of the price into the return performance by time to time. So from the line graph below here, the overall patterns actually follow the same story as I mentioned before for the raw series. So we can still see extraordinary spikes across the all the forex pairs and also the oil price in 2020. Basically, they are the same story due to the COVID-19 shock as I explained earlier. And then for the uh, return of WTI, we can also see another critical spikes happen around the early 2026, which is also due to the Iran US conflict and the Strait of Hormuz disruptions. So basically, the logic is consistent with the raw series data. The interpretation is about the same event, same timing, same incidents, but one of the difference, which is the scale of the y-axis, uh, among the line graph in within this return series. Basically, they share the same pattern, but maybe we can see in the return series line graph, there's more fluctuation ups and downs. This was mainly due to the different scale of y-axis. So basically, actually, they same share the same swing and the same spikes and the same story lah. Basically, there's not too much differ between the return series and the raw series. So the logic behind is also still the same. Uh, the spike on the 2020 to 2021 was mainly due to the COVID-19, and then for the return in WTI, for the spike in the earlier spike, as I draw a arrow there, was also due to the COVID-19 era, and also the other arrow down, the after the first arrow, which is also due to the reason of the US Iran war. So basically, the return series line graph is actually the same story as the raw series data. Thank you. So next, let's take a look on the descriptive statistics for the return of oil and the return of 10 different exchange rate. So basically, from the perspective of mean, which also indicates the return, we can see that the 10 selected currency, actually their means is closing around zero, which indicates a small portion of return, unlike the return for the oil, which indicates 0.047, which is around 0.47% of return, due to the spikes of the price of oil we can see from the previous interpretations. Next, let us take a look on the dispersion, which was measured with the standard deviation. So basically, we can clearly see that the crude oil have the highest standard deviations, which also indicates that it has the highest volatility. Basically, we can see it from the maximum and minimum value. There's about 56% of difference. So basically, that means that from the minimum to the maximum value, there's about difference of 56%, which is extremely volatile. And the other standard deviations for the currencies actually are relatively lower as compared to the oil. So basically, the volatility is lower, comparability low than the uh, crude oil. So next we'll be moving to the Jagabera test. This test actually is to test whether the each of the return series is following normal distribution or not. So basically, a p-value below 0.05 means we will reject a normality, and about if above 0.05, we will accept the normality. So based on the table shows here, nearly all of the data presents zero p-value, which is consistent, except the currency rate of the USD, Thai baht to US dollar. So basically, the p-value is above 0.05. So basically, we can accept the normality lah. So which also explain that we are fail to reject the null hypothesis here, which means that USD per Thai baht returns are the only series in this sample that statistically resemble a normal distribution. So that's all for my part. Thank you.
Hi, I'm Wang Kai. Moving on to the correlation analysis, we examine the Pearson correlation between weekly crude oil returns and our selected exchange rates. Because rates are quoted in domestic currency per US dollar, a negative correlation indicates an inverse relationship, meaning an oil price surge leads to an appreciation of the domestic currency against the greenback. So as shown in the result, we reject the null hypothesis for only two currencies, which is the Canadian dollar and the Australian dollar. Both the currencies display statistically significant negative correlations, which is negative 0.22 for the Canadian dollar and a negative 0.15 for the Australian dollar, with p-values well below 0.5. So this strongly reflects economic theory as major energy exporters. Rising oil prices improve their terms of trade and directly strengthening their currencies relative to the US dollar. However, for most other currencies, including the ringgit, pound, and Singapore dollar, the negative correlations are weak and statistically insignificant, meaning that the weekly oil movements do not reliably drive them. So, interestingly, the euro and the Japanese yen show slight positive correlations, hinting at energy importer currency weakness during oil spikes. However, these are also statistically insignificant. So, in short, the baseline weekly oil correlations are primarily confined to major commodity exporters. Next, moving on to the regression analysis, the table shows that the crude oil returns significantly impact only two currencies, which are the Canadian dollar and the Australian dollars. Both the currencies show statistically significant negative slope coefficients, meaning that an increase in oil prices will strengthen these two currencies against the US dollar, explaining roughly 5% and 2% of their return variance respectively. So, for all other eight currencies, the p-values are well above 0.05, with the R-squared values under 1%, indicating that there is no significant linear impact. So in short, the weekly oil price fluctuations will primarily drive only the net energy exporting currencies, leaving the major reserve and the non-commodity currency largely unaffected. Next, it's the wavelength correlation. The wavelength correlation allows us to break down the oil and the foreign exchange relationship across different time scales, ranging from short-term up to a very long-term horizons at scale 32. So across most currencies such as the ringgit, Singapore dollar, Thai baht, and Saudi riyal, we can observe that the relationship is virtually zero or weakly negative in the short to medium term. However, as we extend into the long and very long-term scales, the correlations consistently shift into negative territory. This reveals that while short-term daily oil fluctuations have minimal immediate effect, the sustained oil price increases lead to structural appreciation of these domestic currencies against the US dollar over the extended horizons. So, interestingly, the major reserve currencies like the Japanese yen and the euro display unique path dynamics, with the yen maintaining a weak positive correlation across most horizons and the euro fluctuating around zero before returning to a weak positive association in the very long run. So in summary, the wavelength analysis demonstrates that energy price transmission through exchange rates is primarily a long horizon phenomenon. Next, continuing with our wavelength correlation analysis, we see a clear, unified pattern emerge as we move from short-term horizons to longer scales. For the British pound and Indian rupee, the correlation remains weak or near zero in the short to medium term before declining noticeably into negative territory at scale 16. So the most pronounced shifts occur in the commodity currencies like the Canadian and the Australian dollar. While both the Canadian dollar and the Australian dollar maintain consistently negative correlations across all horizons, their lines dropped steeply at scales 16 and 32, reaching their strongest negative association in the very long run. So this proves that while the weekly oil price noise creates minor fluctuations, the sustained oil price shift fundamentally lock in the long-term exchange rate appreciation for net energy exporters. Moving to the next sections, the wavelet coherence highlights how energy trade structures dictate exchange rate dynamics over time. So across these five currencies, the data strongly supports classical terms of trade theory by cleanly separating net exporters from net importers. So for net exporters like Malaysia, the long-run inverse core movement shows that the higher crude prices enhance export revenues and strengthen the ringgit against the US dollar. So conversely, the heavily energy-dependent importers such as Singapore, Thailand, and Japan has shown that localized zones of positive in-phase core movement. So for these nations, the higher oil prices directly inflate national import bills, leading to a domestic currency depreciation. And then finally, the Saudi riyal remains largely insulated from day-to-day oil prices movements due to its strict US dollar pact. So with significant coherence appearing only during major global disruptions like the 2020 pandemic shock. So wrapping up the data estimation and interpretation part, we see how wavelet coherence clearly captures both trade fundamentals and macroeconomic safe haven shocks. So for net exporters, the Canada exhibits sustained negative core movement over the long run, confirming that the rising oil prices improve the terms of trade and appreciate the Canadian dollar against the US dollar. So similarly, the Australia displays strong positive in-phase core movement during the post-2022 recovery windows, validating that commodity currency dynamics. And for net importers like the Eurozone, the UK, and the India, a positive core movement emerged during medium-term periods as higher oil import bills weighed heavily on domestic currency values. However, during the early 2020 pandemic crisis, these currencies exhibited temporary inverse long-run core movement, which is a distortion driven by the intense global safe haven demand for the US dollar rather than underlying energy trade. So that's all for me. Thank you.
I'm Junwei, and now I will be talking about conclusion and strategy policy recommendation. So, from the recommendation, our empirical investigation into the transmission mechanism between West Texas Intermediate, which is WTI, crude oil, returns, and 10 major exchange rate that we chosen, specifically USD over AUD and USD over CAD, USD over JPY, USD over GBP, USD over EUR, and USD over INR, USD over THB, and USD over MYR, and USD over SGD, and the last one is USD over SAR. So our data set encompassed 335 weekly observations spanning January 5th, 2020 through May 31st, 2026, noting 334 simple log returns. So to evaluate both static average link and dynamics horizon dependent core movement, our methodology combined descriptive statistic, Jaguar-Bera normality test, Pearson correlation, ordinary least square regression in eViews, and time frequency with LERT coherence analysis in RStudio. So move on to our core finding. So first, we established that the empirical impact of crude oil on the 10 exchange rate is fundamentally commodity dependent and horizon variable rather than uniform across global currency market. Second, regarding market volatility, WTI crude oil exhibit the highest overall volatility with a standard deviation of 0.0801. Among currency pair, the Australian dollar was the most volatile at 0.0154, followed by JPY and GBP, while the Saudi riyal recorded the lowest volatility at 0.0003 due to its fixed USG peg. Jaguar-Bera test confirmed non-normality across oil and the 9 currency pairs, with the Thai baht being the sole exception, demonstrating parametric normality with a p-value of 0.5012. Third, static linear OLS regression provides that statistical significance is strictly confined to commodity exporter, specifically USD over CAD recorded an R square of 5.04% with a p-value under 0.001, while USD over AUD recorded an R square of 2.17% with a p-value of 0.0069. Because of exchange rate are quoted as domestic currency per US dollar, this negative beta coefficient confirms that higher oil return drive domestic currency appreciation for CAD and AUD. Finally, the remaining 8 exchange rate shows statistically insignificant linear relationship with R square value below 1%. However, wavelet coherence analysis revealed that core movement tightened significantly during market crisis windows and over longer investment horizon for commodity currency. And moving to the bottom left content on our side, this empirical finding translate into two core recommendation for investor and asset manager. First, institutional investor must implement currency-specific and dynamic hedging. Because linear relationships are statistically insignificant across 8 of the 10 currency, applying a single blanket oil-denominated hedge across all currency exposure is inefficient. Instead, asset managers should tailor active hedging strictly to CAD and AUD asset, dynamically adjusting derivative hedge ratio using forwards, future, and option when wavelet coherence signals evaluate crisis core movement. Second, portfolio managers should adopt a multi-factor macro framework. Because of WTI crude oil accounts for at almost 5.04 of currency variance in CAD and under 1% in non-commodity currency, asset allocation decision must combine oil on indicator with broader macroeconomics factor, including interest rate differentiation, inflation trends and central bank stance, trade balance, capital flow, and global risk sentiment. So turning on to the bottom right container, we outline policy recommendation tailored specifically for policymaker and central bank. So central banks need to distinguish policy intervention between commodity exported like CAD and AUD, which face currency appreciation pressure during oil surge. Energy imported like JPY, EUR, INR, and THB, which face depreciation and imported inflation as national importer bills rise, and peg regimes like the Saudi riyal, where the fixed exchange rate buffers immediate FX responsiveness. Fourth, policymakers should enhance macro-prudential and wavelet surveillance. Monetary authority in energy importing economy must closely monitor nation import costs and foreign exchange reserve during oil price surge. Central banks should integrate time frequency value to alongside standard linear model to detect transient cross-market spoil over before they impact the domestic currency stability. In conclusion, our study proves that relying solely on time invariant models like OLS can lead to misleading conclusions for risk manager and central banker. Future academic research should build on our finding by incorporating non-linear regime switching models and structural break tests to better evaluate asymmetric energy shocks. So in summary, while WTI crude oil is not a continuous determinant across all currencies, its impact is pronounced for commodity exporter and highly horizontal variable during crisis regime. So through dynamic hedging, macro regime differentiation, and time frequency surveillance, both investor and policymaker can navigate energy market volatility effectively. Thank you so much for your time and attention. I'm done for my part. Thank you.
Well, that's all for our presentation. Thank you.